Good morning, everyone. Thank you for being with us this morning. Coffee and Conversation, once a month, we bring really incredible speakers. And today we're so lucky and so pleased to have Jay Whitehead with us. Jay, thank you for joining. We really appreciate it. Appreciate your time. Jay is a Cal Poly alum. What did you study at Cal Poly, Jay?
My freshman and sophomore year, I was a political science major. And ran what was called the Speakers Bureau at that time. I don't know what it's called now. I was president of my dorm. I was at Tenaya Hall and was planning on running for a school president my junior year, but I decided to transfer to UCLA instead. So
right.
Because I wanted to play. I got an opportunity to walk on and play football there, so I did.
Yes. And you went on, so I'll let you give us we have a few slides to start with, introductory slides. Yeah. But I know I'm going to let you talk a little bit about your background, but you went on to become a partner of UCLA Ventures. You have a tremendous amount of experience in venture funding. And I also would love it if you could spend a few minutes when we launch into the conversation to talk about reentry centers, which is your new venture that you're involved in that is really fascinating. Would love to hear more about that as well. But before we start, we have, oh, sorry.
No, go.
Before we start, we have a couple of introductory slides that we're going to go through real quick. Please use the Q&A for any questions. This is supposed to be a very interactive event, so everyone online, feel free to drop your questions into the Q&A box. I'll send them over to relay them to Jay. Anyone that's with us physically in the room, feel free. We have a cube with a mic. Madison can hand it over to you. You can ask your questions live. We're the Cal Poly SBDC. There are about 1,000 SBDCs throughout the US. We provide one-on-one business consulting at no cost to business owners. We work with close to 600 companies each year throughout the region, and we have 35 consultants on board that can provide advice and guide you and coach you through whatever issues you might have in your business. Next slide, please. We're funded by the SBA, federal agency, but also by the GoBiz office at the state level. And we have a very, very brief video we're going to share from one of our sponsors, Maynard Cooper. Thank you.
Hi, everyone. My name is Jamal Al-Haj, and I'm a partner with Maynard Cooper & Gale in the firm's San Francisco office. Maynard Cooper is a full-service law firm of national reach with over 300 lawyers across 11 offices coast to coast. Our San Francisco practice focuses on advising emerging growth companies and venture capital firms, including with respect to equity management, financings, employment, and intellectual property matters. We are extremely proud to be a Founders Circle sponsor amongst an extraordinary circle of other dedicated philanthropists who recognize the immense value that Cal Poly's Center for Innovation and Entrepreneurship bring to the SLO community. We hope that each of you enjoys this upcoming training and workshop and are able to incorporate the knowledge and know-how that will be presented shortly to further help grow, develop, and accelerate your businesses.
Thank you to our sponsor, Maynard Cooper. And now the best part. Jay, welcome. So as mentioned, you have incredible venture experience, and I'm going to let you talk a little bit more about your background, and then we'll launch into just a conversation around the different experiences you've had in investing in startups. But first, welcome, and please give us a few words about your background, and we'll go from there.
Terrific. Can you? I'm sharing the screen. Can you see that?
Nope.
Okay. Let me try this again, and share the screen. I'll get into my background. There you go. I'll do that and this, and now we are. It looks like we are all shared.
Perfect. That works. Thank you.
Okay. Thank you, guys. Welcome. Appreciate it. So as I was telling Judy, I lived in Tenaya Hall at Cal Poly San Luis Obispo as a freshman and then a sophomore. I ran something called the Speakers Bureau, and we had some lunatic speakers on campus, including Hunter Thompson, the famous Gonzo journalist, and had a lot of fun at Cal Poly. And I transferred my junior year to UCLA, and then continued on from there. But got my BA in UCLA, and then took the opportunity to take an internship, which I encourage everybody to do as an undergrad, as a senior, and got a lucky break and became an on-air reporter and a news writer at Channel 11 in Los Angeles, and had a lot of fun doing that. But TV is a terrible industry. Technology is better. So I went to work in the tech. Went up north. Went to work at J. Walter Thompson and Chiat Advertising and technology marketing, and got a chance in 1983 to join an elite team to launch something called the Lisa computer at Apple Computer, which was the predecessor to the Macintosh. Worked for a complete jerk named Steve Jobs, and have a very off-color story, actually a bunch of very off-color stories about Steve Jobs. I'd be happy to share those stories with any of you offline, certainly not in a public forum. And so over time, I've led 18 startups. I've had 6 exits. An exit is when you sell a company at a profit. I've raised, it says about $250 million. I've raised about $400 million in venture capital and corporate money and angel investing money and EB5 money, which is very exotic. I'm in Orlando, Florida today at an EB5 investor conference. EB5 is the golden passport program of the United States government, where international investors invest in qualified companies and get a green card. And so that's a very exotic type of work. I wrote a book called The Post-Carbon Economy, which I would not recommend writing a book as to anyone who wants to make money out of it, because it's absolutely the slow boat to the poorhouse. Do not write a book. But I've started up a number of companies, many of them in media or technology, and a couple of social enterprises. I am now the CEO of League Network, which was acquired last week by Alliance Reentry Centers. Reentrycenters.com is a social enterprise for which we've raised about $50 million. And Alliance and Reentrycenters.com gets people out of jail. When people come out of jail, they come to one of our reentry centers in Alabama. They get an app called the Reentry app. They get a banking app called Reentry Pay, because 90% of the 1.2 million people who get out of jail every year have no job, no place to go, and no bank account. And so we give them all those things at once. And we've reduced recidivism as a result of our program, Reentry Centers program. Recidivism is when people go back to jail. 51% of people go back to jail, by the way, within 3 years of getting out of jail. We've reduced recidivism by 60% at zero cost to taxpayers. Some of that has to do with technology, some of it has to do with our program. But I'm the chairman and chief technology officer of that company and the largest shareholder in reentrycenters.com. And that'll be a big success story going forward. And I'm married, 3 kids, dual US French citizen. And my hobby, I'm a startup guy, so my job is painful. And then my hobby is also painful. I run marathons. And I've finished 87 marathons on the way to 100, my goal of 100. So pain is my life. So what we're going to talk about today in our little coffee clash with Cal Poly CIA SBDC, I bet there was no competition for that URL. And thank you to Maynard Cooper Gale for their sponsorship of this. What we're going to talk about today is my startup fundraising secret number 3. I have a 5 sort of lesson course for entrepreneurs. But I thought for this purpose, it's probably the most pithy of the course units is this selling to the term sheet, secret number 3. And having raised so much money over time, I've sort of come to understand that I'm a little bit of a fundraising savant. People hate fundraising. Most entrepreneurs are really terrible at it. But being good at it requires a couple of different, you master a couple of different secrets, and I'm going to share them with you here today. And as your parting gift for attending this webinar, you get a free term sheet, a live term sheet, which our organizers, Judy and the team, will share with you via email, and you'll see how to use that. I'm saving you about $3,000. So this 45 minutes or 30 minutes you're spending with us this morning, is it worth at least $3,000, maybe a little bit more than that. So there you go. So let's take this one step at a time. And I'm gonna honor a couple of my mentors along the way with, by quoting them. One of my first mentors was a professor I had at UCLA, a guy I met whose name is Mike Milken. You may or may not know who that is. Mike Milken was called the junk bond king. He came up with this concept of marketing junk bonds. He was the first person in the United States ever to earn $1 billion in 1 year as a W-2 employee of Drexel Burnham Lambert. And he was a legendary private equity guy. And one of his sayings was that your capitalization table, as an entrepreneur, your capitalization table is destiny. Cap table is destiny. You keep repeating. Cap table is destiny. Well, let's start with what is a capitalization table? For those of you who don't know what it is, a capitalization table is simply a spreadsheet or a chart that shows who owns what part of your company. Do you own 17%? Do you own 45%? And then ladders up the classes of shares from common shareholders to Series Seed shareholders to preferred Series A shareholders, preferred Series B shareholders, debt holders, etc. And that capitalization table shows who owns what. So for those of you who don't know what a cap table is, please go to venturehacks.com/cap-table. And there's a full video explanation, and it gives you a free model that you can actually download to build your own cap table. The secret to understanding what a cap table is the secret to understanding one concept, and that is pre-money valuation and post-money valuation of a company. Pre-money valuation is the valuation you apply to your company before you've raised any outside money. Even if you put money in, before you've raised outside money, that's the pre-money valuation. The post-money valuation is the value of the company after you've raised the money. So let's say you have an early stage company and you say, the pre-money valuation of this company is $3 million because you think that that's what it's worth. And you can declare that as the founder. And you raise $1 million in, say, a seed equity round. What would be the post-money valuation of that company? Well, it would be 3 + 1. So pre-money of 3, post-money of 4. And that's how simple cap table math is. It's pre-money valuation plus the amount in, and that's your post-money valuation. And that's how simple it is. Now, it gets really complicated as your valuation stream, as your cap stack stacks up, and you have money you've raised at $3 million pre-money valuation, and then you raise another $5 million, and then your next pre-money valuation for your next round is $20 million, which is dilutive, mathematically dilutive to everybody in the stack, and so on and so on. So it gets complicated quickly, as you can see on that venturehacks.com/cap-table model. It gets fairly complicated. And then there are all sorts of wild derivatives that you come into with options and warrants, which are basically the same thing. And an option or a warrant is a promise to buy something in the future at a price you negotiate now. So that's a complicated concept. So the math gets complicated, but understanding this pre-money and post-money valuation concept, that is the essence of it all. And so cap table math and knowing your cap table is destiny. Why it matters is that the value you build in your company over time by building your products and answering and serving customers and getting revenues, your company increases in valuation, and that's all reflected on your capitalization table. Because if you're an investable company what people will be acquiring is reflected on your cap table. So cap table is destiny. If you don't manage your cap table well, you will fail as an entrepreneur. There's no entrepreneur who has ever built and sold a company that I know of that had outside investors that did not understand cap table math eventually. So it's better to understand it early than understand it late. Because if you understand it late, chances are you're an idiot. You're going to get diluted. Some venture capitalist is going to try and pull the wool over your eyes. And venture capital, and we'll transition into venture capital fundraising now. Fundraising is a contact sport. I had another mentor whose name was T. Boone Pickens. Many of you have never heard of T. Boone Pickens. T. Boone Pickens died a year or two ago. He was a legendary Oklahoma oil man. He's called the King of Oil. And he was also a corporate raider. So he would go out and buy companies. And I befriended him back when I owned another magazine company called the Corporate Responsibility Magazine many years ago. And he had a saying, he had 10 aphorisms, did T. Boone Pickens. Aphorism number 6, which I always loved, was, in a partnership among friends, there's no place for a Wolverine. He hated Wolverines. And his point there, that rule, one of his aphorisms, is a variation on another rule that I have, that I will impart to you. And I apologize for all of those whose ears are gentle in the room. My rule, or my variation of aphorism number 6 of T. Boone Pickens, is the no assholes rule. No assholes in any of my deals. T. Boone Pickens called them Wolverines. I call them assholes. It's different. So let's talk about fundraising. Fundraising is a contact sport. It is very physical. It is very taxing. It is very emotional. It's one of the harder things you can do as an entrepreneur. And the better at it you get, the more money you will ultimately make, and the more money your investors will make as well. So here are 3 really important insights about fundraising. No investors, with very few exceptions, ever want to be the first one in. Everybody wants to follow. So getting that first investor in your capitalization stack is really, really important. It is said that that first investor prices your deal, because whatever he or she pays for that stock is in effect the price that will be the standard for everybody after that. Typically, nobody pays less than that first investor. That first investor really sets the floor. So, and very few people want to be first. There are some rare exceptions to people who really like to be first. Some angel investors really like to be first. I tend to like to be first because I tend to have faith in companies, and I believe in entrepreneurs. But nobody wants to be first, and everybody wants to follow. But let me do a corollary point to that. And that corollary point is that every type of investor has their own sweet spot stage. And it's important when you're pitching an investor to know what that sweet spot stage is. And here's what I mean by that. Some investors don't mind being early. Some investors would rather take a bullet in the knee than be early. They'd rather be late, take some of the risk out. Some investors only invest in certain types of companies, healthcare or biotech or cryptocurrency or whatever. Some investors have a very specific profile, and it's important for you to know that investor's profile before you start pitching. Because if you're pitching to somebody whose profile is outside where your company's outside their sweet spot, save your breath. Don't even bother, because they will never go for it. So if somebody's a biotech investor and you are an e-commerce company, don't even bother. If somebody's a real estate investor and you're a healthcare automation startup, don't even bother. because they won't understand what you're doing and you have almost no chance of getting them as an investor. So really understand the profile of the investor before you start pitching them. Same thing goes for friends and family. If you're pitching Uncle Jimmy, who happens to have some money that because he sold his bottling plant, understand what Uncle Jimmy's sweet spot is. Don't try and pitch him your deal if you're way outside his sweet spot, because you literally will be wasting your breath and you'll frustrate everybody and you may make an enemy. So nobody wants to be first. Everybody wants to follow, and know investor sweet spots. But so the question is, how do you get someone to be first? It's a hard question, but I'll share 4 tricks that I've used successfully over time to get somebody to be first. The first trick is FOMO, fear of missing out. Getting somebody to really believe that it's great to be early on this trend, this mega trend. You want to be on the front side of this curve. Fear of missing out. That is really the most important part of this. Remember, all early stage investing, all investing in early stage companies is 100% emotion. People may say, oh, there's analytics involved, the financial analyst. That is complete crap. It's all emotion. It's 100% emotion. And fear of missing out, fear is the most important emotion that you can tap when you're pitching an early stage investor. By far, greed is an important emotion, but nowhere near as important as fear. And fear of missing out is the number one fear. So FOMO is number one. Number 2 is a board seat. People, early stage investors tend to be on boards of directors because they can look over your shoulder. You have to bring them in the room every quarter or every 6 months and tell them what's going on. So a board seat is really important. By the way, never have more than 5 members on your board. That's a guaranteed recipe for hell. I like 5. 5 is a good number. Always have it be an odd number, because sometimes you will have votes and it's important to have odd numbers so that you can tie break. So board seat is a second way you get somebody to be to go first. The third way is incentives. So incentives are really pricing incentives. And here's typically how they work. So remember pre-money, post-money? So pre-money valuation, say $3 million pre-money valuation. My company's worth $3 million. But if you go first, let's use Uncle Jimmy. If you go first, Uncle Jimmy, I'm going to give you a 20% discount on $3 million. Meaning that you're going to get a $3 million valuation, but I'm going to discount it 20% for you. So you really get in at 2.4 million pre-money, Uncle Jimmy, and the math works, 20% of 3 million is 600,000. 3 million minus 600,000 is 2.4 million. That's a 20% discount for Uncle Jimmy. So that's one way you can do it, is just a straight money discount. Everybody understands discounts. They shop at Walmart. They know discounts. So discounts is one way. The other way to offer an incentive like that is through something called warrant coverage or option coverage. Warrants and options are the same thing. They're a right to buy something in the future at a price you list now. Warrant coverage works like a discount. So if there are 1 million shares in your company and you give someone 200,000 warrants, or the right to buy 200,000 shares at a discount, that in the future, that represents a discount to them. And if you want to email me and have me explain more about warrant coverage, I can. I also can refer you to some YouTube videos on warrant coverage or option coverage. It works just like a discount. It's a discount mechanism. It works really, really well. It's a little bit, you've got to be able to explain it. So it's a little bit more exotic than, hey, you get 20% off, Uncle Jimmy. You've got 20% warrant coverage. It's the same thing, but it's a little bit more complicated to explain. So that's the third of the the 4 incentives to get somebody to go first. The fourth is something called a ROFR, or a right of first refusal. ROFR, R-O-F-R, a right of first refusal. And a right of first refusal is really effective if you're getting corporate investors. Corporate investors love ROFRs. What that does is it gives them the right of first refusal to buy more stock later at a certain price. And that's a good thing for corporate investors, because corporate investors typically, if they're investing in you, they want to buy you later. But what you want to do is you might want to give them a ROFR, a right of first refusal to buy stock later, but at an elevated price. So it's a way of guaranteeing that they can't buy you for cheap. They're going to have to buy you for more expensive. So those are and that's a great way to get a corporate investor. Say you've got a company who wants to invest in you. ROFRs are a really good trick for those guys. So fear of missing out, a board seat, incentives in the form of discounts or warrant coverage, and ROFRs, or rights of first refusal, are 4 real good tricks to get someone to go first, get them to be braver. So finally, in a trick here in fundraising is a contact sport. The second piece of this, of secret number 3, selling to the term sheet, is that the 3 best investor negotiation tricks of all time all start with a C. Competition. Competition is number 1. Without competition, you'll never sell anything. There's a secret in real estate for those of you who have or have not bought a house or sold a house. When you're selling a house, the only way you're going to get a higher price than what you asked is if there's more than one buyer. Competition is it. There's only one way for you to sell advertising space if you're selling advertising, and that is to let a company who's going to buy your advertising know that their competitor is buying from you. It's competition. The best way to find a good date is to let your prospective date know that somebody else wants to date you. I mean, it's the same thing. It's the same damn thing. Competition, number 1. So create, even if you have to create a false narrative around competition, without competition, nobody's going to pay attention to you for investors, among investors. Second is confidence. You have to approach this with confidence. You've got to be confident in what you're selling. And I'm going to tell you in the next slide, my final slide here, the next slide, I'm going to tell you what you need to be confident about. But confidence is everything. I have been told that I have quite a bit of confidence, and that's important. It gives people confidence, knowing that their business is going to be, or their money is going to be well taken care of. Confidence is really important. And then finally, but not the least important, is connection. And when I say connection, that means a personal connection. And when I remember, I told you that all investing, all early stage investing, 100%, there are no exceptions to this, is emotional. And the best way to make an emotional connection with an investor is to make a personal connection. Personal connection now is much easier to make than it has been in the past, for one reason: LinkedIn. If that investor is on LinkedIn, you can find out a lot about that investor really fast: where they went to school, were they a Cal Poly alum, were they a political science major, where did they work, do you have any connections with them, do you have any shared experiences with them, did they grow up in your hometown, are they a Floridian, are they from Jersey, where are they? So all those things are really important to make a connection. Competition, confidence, connection are the 3 C's to investor tricks to get investors in. The three best negotiation tricks that I know of. So now let's move on to the next slide, my final slide, to the point of this lesson: selling to the term sheet. When I say selling to the term sheet is really an important connection, and I owe everything to my first venture capital investor, is a guy named Tim Draper. Tim Draper was the son of the founder, or one of the presidents of the World Bank, father was a great investor, Silicon Valley-based kid. Tim started a venture capital firm called Draper Fisher Jurvetson. Doesn't exist anymore, but was one of the most successful seed investors of all time, if not the most successful. He's still in the market. He started Draper University. He's got his name's on hundreds and hundreds of cap tables, and he's made billions of dollars for himself and for his investors. Tim is just a great guy. So Tim taught me this concept, and the concept in its essence is that when you're selling an investor, you are not selling your product, you are not selling yourself, you're selling the term sheet. Because the term sheet is what the investor is getting. The term sheet describes the investment that they're making and what the return that they'll make on that investment. So you're selling to the term sheet. You're not selling your product, you're not selling yourself, you're selling the term sheet, and you're selling to the term sheet. So what is a term sheet? Well, a term sheet is simply a 4 or 5 page legal document that represents the summary of all the terms of your investment. As a visitor to this webinar, you get one for free from Judy, who's going to give it to you for free. And so you'll see what an actual term sheet is. I've raised at least $100 million based on that term sheet that I'm giving you for free. I use the same form. It's called the Series Seed form, and it's been used thousands and thousands of times. It's a very standard form, but your lawyer is still going to charge you $3,000 no matter no matter where you get it from. But that's a standard form. So there are 3 parts to a term sheet. The first part is the price. What is the price of the investment that you're making? Now, a lot of investors or a lot of CEOs have a preference for convertible notes. Some are called safe notes. Now, I hate convertible notes, and I'll tell you why in just a moment. But a convertible note is certainly a way to sell an investment. A convertible note is simply a loan that converts to stock at some point in the future when you, as the founder, determine. It's kind of an easy way to raise money, some people think. However, I dislike them for one reason, and it's a very important reason, and that is they're a loan and they convert into stock at one point. At one point, they convert into a stock with a per share price at one point. However, almost every time that I've had to convert notes into stock price, there's a rock fight that happens between me or the founders of the company and my investors. It's almost always divisive. It almost always causes friction and bad feelings. So I don't do them anymore. I just don't. So I price the rounds. I say the stock you're buying is $3 million pre-money valuation, 85 cents a share.
So Jake, can I jump in there?
Please.
Why the conflict? Because let's say you've issued a safe doc or a convertible note. When the investors come in at the priced round, they've done their due diligence. They know that, okay, these are going to convert. The terms are pretty, they're set in stone. So where are the conflicts coming from in the experiences you've had?
You think they're set in stone. They're not, because when you sell a safe note to someone, dimes to donuts, you will make oral representations of, oh, I'll take care of you, Uncle Jimmy. Oh, I think, it's a 20% discount on your safe note. And you've got a cap rate or a cap on the valuation. When people convert those safe notes, they always think that they signed up for a better deal than they ultimately got. And so there's always a fight. I've probably, either advised companies or done this myself about 50 times. And every time there's a conflict. And so I just decided I'm never doing one again. And I've never had a conflict with selling priced stock. Plus, in some ways, it's a lot easier to sell price stock than it is to sell a convertible note. Even people think, oh, it's less documentation, less this, less that. No. In the end, you're taking a little bit more effort up front to sell a price note or a priced round, but it's well worth it in the end. I guarantee it. That's why. I mean, it's those early investors, 90% of the time, they're going to want to invest more money later, and you can't afford to have friction between you and them as you go forward. They're going to remember if there was a little bit of friction. Oh, you promised me a little bit more juice. You promised me a little bit of discount over and above what was in the cap in the convertible note. Inevitably, that turns into friction, and it's all emotion. It's just emotion. That's why, Judy. That's why I really shy away from them. In fact, just yesterday, I turned down an entrepreneur who is doing some really interesting things in the social enterprise space, and I just said, look, I can't raise on top of that convertible note because it's just too, you got 16 people with convertible notes. I guarantee you'll have a fight with 12 of them. And I just can't, I don't have time. My life is too short. I can't do those rock fights anymore. So I just won't do it. So that's my advice. I mean, you can do it if you want. I mean, hundreds and thousands of people have done it.
So I'd love to hear how you handle valuation for a priced round when it's very early stage. So that becomes, how do you handle that piece?
That's very, very easy. Low pre-money price. For example, League Network, the company that I just sold, my first round was at $1.5 million pre-money valuation. And I raised $622,000 at 1.5 million pre-money valuation. So I gave away a quarter of a company. Fine. Didn't have any dispute with any of those investors. There were 12 investors in that round, and 8 came into the next round at 5 million pre. 6 months later. So that's how you handle it. It's just a low price. You just have to sort of get your mind around that. But limit the amount of money you're raising at that early stage. Limit the amount. You don't want to raise too much. I mean, I raised $622,000 on 1.5 million. So my pre-money was 1.5 million. My post-money was $2.122 million, or I'm sorry, rather $2.22 million, and that was it. And then the next round I raised was at 5. And then we sold it. We sold at 18. Okay, so that's how it works. So that's how I handle it. It's a low pre-money price to get that seed in, and then you step it up, and step up's the name of the game. So the second part of a term sheet after price is preferences. So when you start your company, you're a common shareholder, which means you just own stock. You don't have any preferences on anybody because it's just you and maybe your co-founders. The next round that comes in, usually a seed round, in the case of the term sheet that I provided you, it's a seed preferred. There are about 20 different types of preferences you can give an investor, that second or third or fourth or fifth layer of investors. The most popular one, and the one that I always give to investors, is what's called one-time liquidation preference. What does that mean? One-time liquidation preference means that if my pre-money valuation is 3 million on the round, and Judy puts in 1 million, my post-money valuation is 4, and then later I sell the company for 20 million. When the cash that 20 million comes in, Judy gets her $1 million back first because she's a preferred investor. That leaves 19 million for everybody else. So if Judy owned 25% of the company at that point, so then she gets 25% of the 19 that's left, and everybody else gets pro rata the portion that's left. But she gets her $1 million back first. That's a pretty good preference. Doesn't cost the company much, but Judy gets a great deal. That's the preference I like the most. There are a whole bunch of other preferences. There are voting preferences, but there are a whole bunch of others. I like to avoid them in the early stages. The only one I like to give is this liquidation preference, and which is really it's really a good preference, and people love it. In fact, I just got through selling this one company and was able to give a number of my investors that liquidation preference, and it was pretty cool. Now, the common shareholder doesn't get any of those preferences. Now, let me talk about one other preference that is popular because Twitter and, or rather, Facebook and Snap and several other social media companies did it, which is supermajority voting preference. For example, Mark Zuckerberg at Facebook gave himself shares that vote 10 votes per share, meaning that nobody can ever take him out of the company. Nobody. He's got 10 votes for every one of his shares. And as long as he owns at least 10% of the company, nobody else can ever vote him off the island. So super voting is kind of trendy. You'll see a lot of term sheets now with super voting for the common shareholders. 5x, 5 times, 6 times. It's kind of trendy. You'll see investors push back on it really hard, but it's kind of trendy. So preferences are the second types of important parts of a term sheet. And then the third, go ahead.
Good question on that. Alec is asking, do future investors look poorly on the liquidation preference? How do you handle that conversation?
It's a good question. Thank you, Alex, for that. So let me answer that. Let me answer that by going sort of into the future. So the common shareholder has no preferences. That seed investor has like a one-time liquidation preference. Okay. Then as you get into like Series A and Series B, future preferences, you can never give the next round fewer preferences than the one before. So they ladder up. So if you give your seed investor, that second group in, one-time liquidation preference, you got to give the Series A investor one-time liquidation preference as well. You may give them other things. You may give them some other preferences. And then you have to give the B, the next one in, one-time liquidation preference as well. So you can, when you give preferences, you can never pair them back. They always just multiply on top of each other. So that's the answer to the question.
Thank you.
Third part of the term sheet is projections and promises, otherwise known as reps and warranties. Reps and warranties are representations and warranties are what you promise to your investors. You promise that you haven't committed a felony in the last couple of weeks. You promise that you are not providing financial statements that are fraudulent. You promise that you have paid your taxes. You promise that you have done a good job of doing projections. So you make a bunch of promises, and those projections and promises are really important, because if you make untoward promises or projections, people later, and the company fails, people will later come back and accuse you of leading them down the road to perdition. And that's not a good discussion. Now, coming from a guy who's had 18 startups, 6 exits, and 5 bankruptcies, you've got to make sure failure happens. As I mentioned in my introduction, I am a dual U.S. and French citizen. Now, the cultural difference between the Americans and French people the gulf is quite large, and one of the cultural differences has to do with our concepts of failure. Silicon Valley, our concept is fail fast, fail often, fail early. Great. French have a saying, l'échec, c'est la mort. Failure is death. A complete opposite. If you bounce a check, if you have a checking account in France and you bounce a check, you will never get a checking account again for 7 years. If you bankrupt a company, you might as well just kill yourself. You will never get a bank account. You'll never get investors. So it's, one thing that's unique about the American system is we embrace failure. Our bankruptcy system is the most progressive, advanced, and lenient on earth. And that's one of the reasons that this economy is so vibrant, is because we embrace failure. Because guess what? Not everything works out. Stuff happens. And so, but making viable projections and promises and is part of the bulwark that holds up this the system that we have here of trust transfer in investors trusting their money to companies and trusting that the company is going to do its best to try and make something of this. And if it works, if it doesn't work out, at least you tried your best, and the investors can't sue you. On the other hand, if you promise something that was truly fraudulent, you promised that you owned an asset and you didn't own it. You promised that you paid your taxes and you didn't. You promised that you had the rights to sell this in this country or this kind of product, you had licenses and you didn't, then you made a fraudulent representation, and those projections and promises that you signed off in the term sheet, or your term sheet and your shareholder purchase agreement are going to go badly for you. Anyway, price, preferences, projections and promises. The 4 Ps are what are essentially in the term sheet. There's a bunch of other boilerplate languages, but those are the 3 big pieces. Now, a couple of other points as we reach the late stages of this little talk. Why is selling the term sheet the opposite of selling your product? Well, I can't tell you the number of pitches that I've sat in, company pitches, where the entrepreneur, the CEO, the founder was so passionate about his or her product and explained the product. And at the end of the presentation, I had no clue what they wanted me to invest in. I have no idea. I didn't know whether they wanted money. I didn't know whether they wanted, I have no idea. So selling to the term sheet is really important. You're selling an investment. You're not selling your product. Yes, you've got to cover what it is you do. Yes, I'm an e-commerce company. We sell sneakers. We sell sneakers better than the next guy because of this or that or the other thing. That's important. That's one slide, but that's only one slide, maybe 2 slides of a 5 or 6 or 7 slide investor deck. What I'm really selling is I'm selling to the term sheet. Now, question 3C here on the slide, how do I get a term sheet for free? Well, all you have to do is just wait, and Judy's going to send it to you in the email without paying a lawyer. I'm sure our friends at Maynard Cooper Gale will gladly take that term sheet and then turn it into a shareholder purchase agreement and a shareholder agreement and charge you an arm and a leg. But they'll certainly embrace the Series Seed term sheet that you're getting for free as an attendee at this fine event. One of the big questions here in selling to the term sheet and creating and building your cap table is how, in God's name, do I set and defend a valuation for this company that's basically a PowerPoint slide deck and me in a garage? How do I do that? Well, it's an art, not a science. But where you start is you go to crunchbase.com. Go to crunchbase.com, and in 15 or 20 minutes, you can find, I guarantee, I don't care how unique your offering is, I guarantee you'll find at least 5 companies that you can argue are competitors. And you can find out what their pre-money valuations were in their early rounds. It's very, very simple, very easy. Sometimes it It'll cost you $20 to subscribe to Crunchbase Supreme or whatever they call it, premium. But you can find peer or comparable valuations for early rounds from companies that were in your situation. And you've got to make sure you're searching geographically, because valuations vary widely based on where you are. Now, if you're in San Luis Obispo, you have to decide whether you're going to value yourself as a Silicon Valley company or as a Los Angeles company, a Southern California company, or something else. And that goes to my next point, was that term sheets and valuations are seen very differently by people from different places in this country, or from Europe for that matter. I've raised a lot of money in Europe, and I've raised a lot of money in Asia. People see term sheets and valuations extremely differently based on where they're from. So let me give you a quick lesson there. West Coast investors, whether you're in Silicon Valley or in Los Angeles, almost always look at company early stage valuation through a TAO lens. I'll tell you what that means in just a minute. East Coast investors look at it on a TAM basis. Here's the difference. TAO stands for total addressable opportunity. That's West Coast. TAM is total addressable market. Why is there a difference, Jay? I have no idea what you're talking about. I think you're nuts. But here's why that's different. A total addressable opportunity is a much larger definition of your market than total addressable market. Total addressable market is what is there now. What is there now? Total addressable market for e-commerce of sneakers is the total value of all the companies that are selling sneakers now. The total addressable opportunity includes people who are not selling sneakers and who may be selling other things. Your e-commerce platform may address a bigger opportunity. So West Coast valuations, that's a long way, a complicated way of saying West Coast valuations tend to be higher than East Coast valuations. There's another reason that East Coast or Midwest valuations are lower than West Coast valuations, and that is where people made their money. Most East Coast or Midwest money was made by people who were in arbitrage type markets. Wall Street's a classic arbitrage market. I buy low, I sell high. My profit is the difference between the two. Wall Street and Midwest investors tend to be really focused on unit economics. How much does a widget cost you? How much can you sell it for? What's the difference? And what are my unit economics? How many SKUs are you selling per month? How many customers are addressed per month? What's your annual recurring revenue rate right now versus what it will be in the future? Unit economics, East Coast. West Coast tend to be, oh gosh, how can I blow this up? How can I tend to be really more blue ocean sort of opportunities? You can define your market a lot larger on the West Coast than you can on the East Coast. If you come from Silicon Valley and you try and pitch a venture capitalist in New Jersey with sort of a blue ocean description of the size of your marketplace, he will laugh at you and throw you out of his office. If you talk about unit economics and have a more reasonable valuation, a $3 million pre-money valuation versus a $10 million pre-money valuation, you're going to get an audience in New Jersey. A $10 million pre-money valuation on a early stage startup might be even more attractive to a Silicon Valley investor than a $3 million pre-money valuation, because Silicon Valley investors like you to aim high and address the market and make the market bigger, make the market opportunity bigger. Generally, West Coast investors are market size investors. East Coast investors tend to be unit economics type investors. But both of them share one thing. They're both types of investors bet on the founders. Now, remember, there are three parts to most investor analytics. This is another one of my my fundraising lessons, but I'll give you a preview of that. There are three parts to investor analysis: the driver, the race, and the car. Driver, race, and the car. The driver is the founder. The race is the market size. The car is what's the product or the service that the company's offering. Driver, race, and car. East Coast versus West Coast investors define drivers, races, and cars a little bit differently, but the one part of their analytics that are most common are the characteristics of the driver. So there you go. Finally, three closing secrets. But before I get to the three closing secrets, let me share a TED Talk that you should all watch. And I'm gonna spoil it for you, so you don't have to watch. I'm gonna spoil it for you because I'm gonna tell you the punchline. But the TED Talk does a really good job of keeping the punchline secret until the very last moment. So the TED Talk is from a venture capitalist, the most prolific seed stage venture capitalist of all time. His name is Bill Gross. Bill Gross, 500 startups. He's probably invested arguably in 3,000 companies. 3,000 startup companies. And you just look, go to TED Talk, type in Bill Gross, and his TED Talk will come up. And his TED Talk is this: as he got to about 2,500 startups, and he realized he invested probably in more startups, successful and unsuccessful, than anybody in the history of startup funding. So he realized, gosh, we've probably got a pretty good database that would tell us what were the success and the failure factors for all these companies. What was it? Team? Was it schools? Was it location? Was it capitalization? Was it market size? Was it timing? What were the factors? And more importantly, what is the most important factor for us as investors? What should we look for going forward? So he got a bunch of MBAs from UCLA and Harvard and Stanford and put them all in a room and said, guys, crunch this data and figure it out. Several months later, they came back with the conclusion: Bill, the success factor that is number one, more important for company success than any other is luck. Timing and luck. As a result, I'm going to tell you the three closing secrets now, but what I've just given you is the journey you're about to go on. Whether you're just considering a startup or in the startup or have even done one or more startups, successful or failure, the thing that's going to determine your success or failure more often than not, and more than anything else, is just damn dumb luck. So I hope you're lucky. And if you're not, keep going, do it again, because guess what? Fail fast. Okay, final. Let's close this damn thing out. I'm sick of listening to you, Jay. Three closing secrets. What are the three secrets to closing an investor, to actually making them hand you the check or wire you the money? Number one is the alignment between price and the personal preferences of that investor. Is Uncle Jimmy into the type of investment that you want him to make? And is the amount of money that you're asking him for within Uncle Jimmy's budget? Can Uncle Jimmy afford that $100,000? Or is $50,000 better for him? Or is Uncle Jimmy just dirty wealthy and he's, $1 million is the right number to ask for him because he really believes in you? So it's that price and personal alignment. You've got to get that person's preferences correct and you've got to ask them the right price. If they don't have the $50,000, but they have 25,000, then get the 25. If they are not into your, if they really want you to spin your company as an e-commerce company, but you really think it's a big data company, then maybe it really is an e-commerce company. So but aligning the investor sweet spot and the price that they're comfortable with is really important. A note there, I've had dozens, if not 100 investors over time say that they want to stage their investment. So I'm good for 100,000, but what I want you to do, Jay, is I'm going to give you 25,000 now, and I want you to prove point X or point Y, and then I'll give you another 25. And then I want you to prove another point, and then I'll give you another 25. Now, you may determine that going through the pain of all those proof points is just too difficult for you, and you may not want to do it. But don't rule it out, because that's often the way to get a good investor early on. I've done that dozens and dozens of times. And if I'm confident in the proof points, then you'll be fine. But it may be a good way to build the trust up with that investor. And on that point, before I get to the other 2 points, let me share the concept of the trust battery. It's a very simple concept. Many investors have this in their head, and you as a founder should have this in your head as well, the trust battery. The trust battery is a concept first posited by a couple of professors at the Stanford Business School. The trust battery is that in any relationship with any human, especially in business, whether it's an investor or a customer or even somebody you're trying to hire, at the beginning of any relationship, there's a trust battery between you and that person. And at the beginning of the relationship, that trust battery is charged at 50%. And going forward, on any given day, the trust battery can charge up higher or it can discharge lower. But that trust battery always exists between people. And it's really important, especially in this price and personal alignment concept, especially with this concept of if somebody wants you to do their investment in tranches, that over time, the trust that they have in you grows, because investment is nothing more than trust transfer. So that trust battery is an important concept to keep in mind. Now that I've mentioned it to you, it's such a simple, stupid concept, but it really exists. It's how we all think of relationships. I don't care whether you're talking about boyfriend, girlfriend, or investor, founder. It's the same thing, or even employer, employee. Trust battery, important thing. Second of the third closing secrets is deadlines. You're never going to close your funding unless you put a deadline. And that deadline, 95% of the time, is artificial. And who declares it? It's you. And stand by your deadlines. When it's too late, it's too late. The price goes up after that, or we missed our window, or I'm sorry, I have no more room for you in the investment you missed. Deadlines are really, really important. Without deadlines, nothing gets done. Nothing. And so I really stress putting a deadline in your term sheet that unless the investment is not received by this day, this offer is no longer valid. And then finally, competition. Create the illusion of competition, even if there isn't any competition. Even if Uncle Jimmy is the only guy you could possibly get a nickel from, make sure Uncle Jimmy thinks that there's somebody else, because otherwise Uncle Jimmy's not going to give you a nickel. So that price and personal alignment, set a deadline, create the illusion of competition, and that, Judy, is the end of selling to the term sheet.
Jay, that was so good. Thank you so much. This is great. I mean, it's a really great way to build up the confidence in our young, startup founders. These are all questions that come up all the time. How to set valuation, how to yeah, how to connect with investors when you're super early stage. And you've shared some really invaluable information. Thank you so much. Thanks for your time.
You're welcome.
So I'm checking comments. So we do have one quick question. Unfortunately, we may have to take this offline because it is 9:38, so we're past our cutoff. We have, I believe, one more slide real quick that I'm going to share with upcoming events. We have AngelCon coming up. We have 6 startups that have been getting ready for this event for the last 9 months. It's a Shark Tank type event. It's live. It's at Slow Brew, April 21st. Come in person. There are a few tickets left. We don't have a lot of tickets left. There are a few left. There's about 200 seats available. I think we have about 40 tickets left. CJ, I'm learning. I'm creating FOMO.
See, there you go. Keep going.
And then our
You'll be sorry if you miss out. Oh my God.
This is the event of the year.
There you go. Now you're getting it.
I'm a fast learner. And then we have Coffee and Conversation May 12th. And we have investors from our investor group for AngelCon that will be here to report back on why they invested in the startup that they invested in and reporting back on their experience. So that'll be a super fun coffee and conversation next month as well. I think that's it from us. Thank you all for joining. And Jay, hopefully let us know when you're on the West Coast. Stop by.
I will indeed. Go Mustangs.
Okay. Thanks, Jay.
Bye-bye.
Everyone, have a great day. Bye.